Denison Mines Corporation, trading under the ticker symbol DNN on the NYSE American and DML on the Toronto Stock Exchange, is currently priced at approximately $2.32, marking a significant intraday movement of over 5% and placing it near the high end of its 52-week range of $1.08 to $2.47. This robust price action is a clear reflection of the broader, resurgent interest in uranium, an asset class many considered dormant for years. Yet, while the market's attention is fixated on the obvious catalysts, the global pivot toward nuclear energy, long-term contracting cycles, and geopolitical supply chain vulnerabilities, the true, more subtle driver of Denison's recent performance and a key factor in its forward trajectory lies in something far more technical and far less sensational: its strategic financial engineering, specifically its recent series of convertible notes offerings. This is a company not just riding a sector wave, but actively and shrewdly leveraging that momentum to de-risk its most valuable assets and solidify its balance sheet in a way that fundamentally alters its long-term project economics. The prevailing narrative surrounding Denison is one of pure and unadulterated leverage to a rising uranium price. The story is simple and compelling. As the world embraces nuclear power as a clean energy solution, and as sanctions on Russian supply and a renewed focus on energy security tighten the market, the price of uranium will inevitably climb. As a developer with the world-class Wheeler River project, Denison is positioned to be a primary beneficiary. This expectation is not wrong, it's just incomplete. The deeper reality is that Denison's management is not waiting for the market to come to them. They are actively shaping their own future, a fact most casual investors miss. The recent announcements of a series of upsized convertible senior notes offerings culminating in a US $345 million raise is a masterclass in this approach. On the surface, it's just a debt issuance. But beneath that, it's a non-dilutive, low-cost way to finance a multi-billion-dollar project in an environment where traditional equity financing would be highly dilutive and project financing is still complex. By securing this capital now, they've insulated themselves from future market volatility and a potential slowdown in investor sentiment. They're effectively converting the high-flying stock price, in expectation of future value, into tangible, near-term capital that can be used to advance the Phoenix In-situ recovery project. This move, more than any spot price fluctuation, demonstrates a sophisticated long-term vision that transcends the typical junior miner playbook and positions them as a serious player, not just a speculative bet. What makes this financial maneuvering particularly compelling is how it aligns with the company's technical strengths. Denison's flagship project, Wheeler River, is not just another uranium deposit, it's a game-changer due to its unique geological characteristics that are perfectly suited for in-situ recovery mining. This method is a profound departure from traditional open-pit or underground mining, which are expensive, environmentally disruptive, and often face significant permitting hurdles. In contrast, ISR involves injecting a solution into the ore body to dissolve the uranium, which is then pumped back to the surface for processing. The genius here is twofold: economically and environmentally. From a cost perspective, ISR is a fraction of the cost of conventional mining, and Denison's preliminary economic assessment for the Midwest ISR project further validates this, outlining a robust after-tax NPV of $965 million. This low-cost structure is a massive competitive advantage, ensuring profitability even if uranium prices pull back from their highs. Environmentally, it's a far more sustainable method, significantly reducing the surface footprint and waste rock, which is a critical factor in a world increasingly focused on ESG, environmental, social, and governance investing. This alignment of their technical strategy with their financial strategy, raising capital to develop a low-cost, low-impact project, is the true engine of their value creation. The market might see rising uranium prices, but the smart money sees a company de-risking a unique, profitable business model from both a capital and operational standpoint. They are building a fortress of a business that is resilient to the cyclical nature of commodities. This dual focus on technical innovation and strategic finance is not a recent development for Denison. It's a core part of their DNA. Consider the company's decades-long history in the Athabasca Basin. They didn't just stumble upon these deposits, they have been pioneers in exploration and de-risking for years. Their recent receipt of provincial environmental assessment approval for the Wheeler River project is a testament to the meticulous, long-term work that goes into these endeavors. This is not a flashy, overnight success story. It is a methodical, step-by-step process of earning the right to operate, a process that is often overlooked in the frenzy of daily market movements. The approval, while a headline, is the culmination of years of detailed environmental studies, community engagement, and regulatory compliance. It serves as a powerful signal to the market that a significant barrier to development has been overcome, paving the way for the next phase of de-risking, final licensing and construction. This milestone, combined with their financial savvy, transforms the stock from a speculative play on an idea into an investment in a tangible, de-risked project with a clear path to production. It's the difference between buying a lottery ticket and buying a share in a business with a well-defined plan. The capital from the convertible notes will now be deployed to move that plan forward, funding critical feasibility studies and engineering, and further de-risking of the project to ultimately attract a final investment decision. Furthermore, we must place Denison's position within the broader geopolitical and macroeconomic landscape. The global energy transition is no longer a theoretical concept. It's a tangible, multi-trillion-dollar reality. Nations like France, the United Kingdom, and the United States are all signaling a renewed commitment to nuclear energy as a cornerstone of their energy independence and decarbonization strategies. This is a tectonic shift from the post-Fukushima era, where nuclear power was often a taboo subject. The Russian invasion of Ukraine has only accelerated this trend, highlighting the severe vulnerabilities of reliance on fossil fuel imports and creating a powerful imperative for secure domestic energy sources. Uranium, as the fuel for nuclear power, sits at the very heart of this new paradigm. Denison, with its Tier 1 assets in a politically stable jurisdiction like Canada's Athabasca Basin, is uniquely positioned to capitalize on this. The stickiness of this demand is what is missed by those who only focus on the spot price. Long-term contracts between utility companies and uranium producers, which are the lifeblood of the industry, are being signed at increasingly higher prices, a clear sign that utilities are securing supply for years to come. This creates a solid revenue floor for future producers like Denison, fundamentally altering the risk profile of the business. The company's recent move to restart production at McLean Lake in partnership with Orano is a smaller but highly symbolic step. It shows that they can not only develop future mines, but also have the operational capacity to participate in the current market, generating some revenue and proving their mettle. This operational validation, no matter how small, adds another layer of confidence for investors. Ultimately, the market narrative about Denison Mines as simply a leveraged play on uranium is far too simplistic. The real story, the one that holds the key to its future, is a complex tapestry of shrewd financial strategy, technical innovation in a challenging industry, and a deep understanding of the long-term geopolitical forces at play. By issuing convertible notes, the company has transformed a high-flying stock price into concrete funding for its world-class Wheeler River project, insulating itself from future market drawdowns and sidestepping the massive dilution that would come from a traditional equity raise. They are leveraging their position not just on a macro trend, but on their specific, low-cost ISR technology that sets them apart from the competition. And finally, they are operating in a jurisdiction that is becoming increasingly critical for Western energy security. The expectation is that Denison rises with the tide. The reality is that they are building their own ship, a vessel uniquely designed to not only ride the wave, but also to navigate the choppiest waters and arrive safely at the port of production. This deeper understanding is what separates a short-term trade from a long-term investment thesis. The company is not just speculating on the future, it is actively building it, one strategic move at a time, solidifying its place as a cornerstone of the next generation of clean energy.